All right, let's talk about Better.com. The digital mortgage lender just announced a massive strategic shakeup, a really bold plan to shore up their finances and, well, secure their future. So let's dig in and see what this is all about. And this quote right here from CEO Vishal Garg, it really tells you everything you need to know. The whole idea is to build a company that can stand on its own 2 feet, right? One that can make big moves without constantly needing to ask outside investors for cash. So how are they going to pull that off? Well, this isn't just some minor course correction. Better is launching a full-scale overhaul. We're talking about a big 3-part plan that really touches every single part of their business, from their finances to their global presence to how they use technology to cut costs. Okay, so here they are, the 3 pillars of their new strategy. First, get a fresh injection of cash. Second, simplify their operations around the world to really focus their efforts. And third, use their own technology to get a lot more efficient. Let's break down each one of these. First step, the money. Better is looking to raise a cool $69 million through a public stock offering. And this isn't just pocket change. This is a serious cash infusion meant to fuel their next chapter. So where's that cash coming from? Well, they're putting nearly 1.9 million shares of stock out there, and the key thing to remember is that this money isn't just for plugging holes or paying off debt. It's earmarked specifically for growth, for strengthening the company from the inside. Next up is that simplification piece. Better is pulling out of the UK market. They're in the process of selling their bank over there, which is a really clear signal that they're trying to focus their energy and resources where they think they can have the biggest impact. And the third piece of this puzzle is all about reducing costs. They're aiming for at least $25 million in annualized savings. But what's really interesting is how they're doing it. This isn't just about typical belt tightening. It's about leveraging their secret weapon, an AI platform they call Tinman, to automate the loan process and just become way more efficient. So that's the plan, right? Raise cash, simplify, and cut costs with tech. But the real question is it actually working? Let's take a look at the early numbers because they are pretty revealing. Get a load of this number, 89%. That's the year-over-year increase in their funded loan volume. That is not just a small step up, that is a huge leap. And it's a really strong early sign that things might be starting to click. And to put that 89% jump into perspective, it translates to $1.64 billion in actual funded loans. But what's maybe even more impressive is that this number blew way past what the company itself had predicted. And anytime a company can beat its own forecast, that sends a really powerful signal to the market. Now, more business is great, but what about the bottom line? Well, take a look at this. This chart shows a dramatic turnaround. A year ago, they posted a loss of $59 million. Now, that loss has been more than cut in half, down to $24 million. That is a massive improvement and shows they're getting their financial house in order. Remember that $69 million they were raising? Here's the direct impact. Before all this, they had about $100 million in cash. Afterwards, they're looking at around $130 million. That extra cash provides a much healthier cushion, giving them way more flexibility in a really tough market. So when you put it all together, more loans, smaller losses, and more cash in the bank, it's all pushing toward one major goal: profitability. They are on a mission to finally get to that break-even point, to get into the black. The specific term they're using for this goal is adjusted EBITDA break-even. I know, that sounds super technical, but it's pretty simple. It's basically a way to measure the profitability of their core business operations, stripping out all the noise from things like interest and taxes. It just gives a really clean picture of whether the business itself is making money. So here's the roadmap they've laid out. They've already managed to shrink their quarterly loss to $24 million. Now, these new strategic actions are officially in motion, and the big target on the calendar? Hitting that break-even point by the end of the third quarter of 2026. That is an ambitious goal, but they're saying they have a clear line of sight to get there. So you've got a new plan, fresh capital, and some real momentum. Better seems to be on a much clearer path. So the big question we're left with is this: is this combination of a stronger balance sheet and a tighter focus finally what they need to not just compete, but to actually master the mortgage market? It's a huge bet, and we're definitely going to be watching to see if it pays off.